Hello, Brian Shannon here from alphatrends.net. Today is Tuesday, the 18th of December, 2008, and the market finished with a nice gain here today. You can see here on the daily time frame of the Qs that the market is back above that 50-day moving average for the first time since back here in September. September 2nd, actually, is the date that the last time this market was above that. Keep in mind that the 50-day moving average is still declining, and rallies generally fail while that 50-day moving average is declining. But the intermediate term trend, obviously, we've still got some good strength here. The NASDAQ finished with a 4.8% gain. A couple weeks ago, I was pointing out the Chinese market and how that market had been stuck under that 50-day moving average. It closed above it, and then it's continuing to see some strength. So perhaps we'll see our market unfold a little bit similar to the way the FXI is here. Right now, again, we remain in a primary downtrend. That hasn't changed. We're still obviously in a bear market, but it's providing us with a very nice bounce trade in here. What we had happen today, first of all, we've seen this uptrend line has continued to hold, and this prior support or prior resistance, which had become support the last few days at about 28.5 or so, did hold early on. In fact, the market gapped higher today, got back above that 5-day moving average in this previous level in here at about $29.70. And prior to the Fed meeting, I said, basically if it can hold above this level and leap above 30.25, then the shorts may panic here. So it looks like we're seeing a little bit further continuation of the recent strength, and nothing here suggests that that short-term strength is slowing down. Right after the Federal Reserve announcement, as always, the market got very volatile in here, but we did have a nice pattern of higher highs and higher lows. We had this little lower high, but we found a higher low just below that. So had it taken this level out, then there would have been reason for concern. It held a higher low and then rallied higher from there. So nice action here in the NASDAQ today. One thing that's just a little bit of reason for concern, nothing to get really worried about here, is the fact that it's unable to get above that $30.65 level, which, if you recall, is the 2/3 retracement of the election high to the most recent low right in here. So this level continues to be about $30.65, the more important level of resistance that this market is going to have to overcome. And it's more like about $30.80. So $30.80 is really the level where it's found the selling recently. But constructively, we have these higher lows in here. So we're seeing good action here on the short term today, and that's what pays us is the short term trends. Obviously, you want to, if you're an investor, you want to position yourself for the longer term. But I still don't think there's that there's anything here suggesting that a longer term bottom has truly been found. So you still have to look at it as a trader's market. Oil today was down about 1% here, and just looking at this 5-minute time frame here of the last 5 days, it just continues to be a very, very choppy trading environment. Gaps higher, then this real sharp sell-off and attempted recovery, and then a sharp sell-off in here. I mean, these are big moves here from 37 down to 35. So I continue to think that oil just remains too crazy for my style. I'm not really interested in trading it, but I know a lot of people are trying to pick the bottom in there, and the bottom is a process. It's not an event, and there's nothing to suggest that the bottom has been found. We're not even getting these moving averages to cross yet. So I would say, generally you want to stay away from oil. There's better trades out there. The financials closed below that $13 level still. So as impressive as today's 11% gain was, and that's what it did rally here, was 11.1% with its $1.30 gain. It is below the declining 50-day moving average and below that $13 level that had been important support for it prior. So we're seeing encouraging signs, though. There continues to be this pattern in here on the 30-minute time frame. We do have higher lows and higher highs. I mean, we're getting these nice trades, tradable rallies, and it looks like we took out some resistance here in the 5-day moving average at about $12.20. So I think that paves the way high, for choppy trading higher, and it should continue to be choppy. I don't think there's any reason to chase the strength in here. So if it can pull back maybe towards 1250 or whatever kind of action we get intraday, I don't think you want to be chasing it up at these levels here. That's again, just manage risk, and we remain in a downtrend, obviously. So you have to be very careful about what you purchase and when you purchase it. Here we can see that a couple trend lines. This is a 120-minute time frame. It goes back to September. So you can see here's a trend line that hit on the election highs, and then from that election highs to the most recent highs, the market was halted there as well. So something to be aware of. The Fibonacci for this market, that 2/3 retracement, is right up here at about 1365, another level just to be aware of. But you got to be impressed with an 11% rally. It's hard not to be, and I hope you weren't looking to fade this move, because obviously the buying in here was relentless, and the short sellers have been maybe a little complacent in here, and when it comes when you get these rallies, the natural instinct for a lot of those short sellers is to cover so that they can limit their losses, because we're getting in here, we're getting a nice rally higher. Here's stage 4 downtrend, a little accumulation. Now we've got this stage 1 accumulation in here and made a higher high. Now we want to see a pattern of higher lows and higher highs continue to materialize in here. So I would monitor pullbacks in the XLF, look for low volume pullbacks, and then buy it as it begins to rally again. But keep in mind that they are short-term trades in here, and there continues to be a lot of risk in this market. The Russell 2000 was up 6.5% with its $2.95 gain. It also was unable to get above these recent this recent level of resistance near about the about $50 a share. But we do still have this constructive pattern of these higher lows in here, and it looks like there's a good possibility that we hit on that resistance once again, that maybe it punches through there and continues to put some pressure on the short sellers, who again have likely become pretty complacent in here. We're right at that declining 50-day moving average. That's not a reason to sell short. It's not a reason to do anything other than look at it and say, we're at this level where the market gets a lot of attention, so let's see how it acts. Well, short term, how it's acting is very bullish here today. Once it leapt above that 5-day moving average, that 5-day moving average held as support, and then the market took off from there after the Federal Reserve meeting. Of course, not until we had a really nice little shakeout in here, and the volatility was, as it typically is after a Federal Reserve meeting, very large, a lot of false moves. But at the end of the day, we had a nice move higher. And looking at a 30-minute time frame, we can see that. Let's look at this 120-minute time frame, actually, or hourly time frame rather. We can see here that this level continues to be an area where the sellers have been, and that again is just under $50 a share. It's also from the election high to the recent low. It's also coincident approximately with that 2/3 retracement in here. But again, short term, we've got a nice pattern. We've got big volume in here as this market rallied, and it's you got to just keep your mind open to any possibility. A lot of people are pointing out headlines and saying, well, the news is still bad. What about the unwinding of this hedge fund or whatever fraud is out there? And again, the only thing to really focus on is price action. It continues to be an environment for short-term trading, because yesterday it looked like it was breaking down here with these lower highs. It gapped up this morning, and had you gone home short, you would have been in for a surprise here on the upside. But you have to be flexible in this market. That's the only way that you can really, in my mind, maintain any sanity with all these crazy movements. The semiconductors were up $1.07 today. They did clear that 50-day moving average, so that's good to see. This is the level I pointed out last week or earlier this week that might also act as resistance, was these highs right here at about $18.70. So it made it up to that level. But this group has been generally the stronger group. Once it made it past that $17 level, we saw that little shakeout in here, and it took bad news to get it above 17. It took bad news to test 17, and now with no news, it's for the semiconductors specifically, that is, it's rallying, it's making these higher highs and higher lows. It does remain in a primary downtrend, but we can look at this and take a look at that Fibonacci in here from the election high to the recent low. We're right at that 2/3 retracement. That 2/3 retracement lines up right here with these highs from November 13th. So that's the reason why I don't think you want to be really super aggressive on the long side, because these are potential levels that where supply may come to the market, or where buyers may just go on strike. These are areas, they're inflection points. They're not anything more than just something that a lot of people look at. So that's why it might become important. If you're long the semiconductors, just keep raising your stop under these higher lows for whatever time frame it is that you're trading on. We had a very strong close for the semiconductors. They act really good short to intermediate term. 1 to 10 days is what I would consider there. But again, the primary trend still remains lower. The risk remain to the downside. The SPY S&P 500 did close above that 50-day moving average, but below the recent resistance right in here. More times resistance is tested, the more likely it is to fail to hold the market back. We've got these higher lows in here, and the market traded a little bit heavier volume. You would have liked to see much heavier volume than it actually did for the percentage move that we had. But again, only price pays, and obviously, this market closed right up near the highs today. Same thing in here. We saw the market gap higher. It held above that 5-day moving, the 5-day moving average right around in here, and then on that 10-minute time frame, it just rallied off after the Federal Reserve. Higher highs, higher low. We had a higher, equal high here, but then a higher low, and then it really took off after it shook some people out. So the market action continues to be constructive. We have to look at, maybe this market is following similar to the Chinese market with the FXI here when it got above its 50-day moving average. Typically, with a declining 50-day moving average, the rallies will fail, but it doesn't mean there aren't some great trading opportunities, and that's exactly what we're seeing in all these markets, that we have some great trading opportunities. And here the SPY is coming up to this level at about 92.25. That has been important as far as resistance recently. So that's why you can't get too aggressive right now. What we want to see is the market maybe rally up beyond that, pull back on lighter volume, and then continue up. Then we can start thinking about targets up here such as the $100 level.